the speaker for the advisor side is unable to get in. Coming off the substitutes bench is our editor, Tom Ellis, who will be running the questions and answers to help and support in asking questions from an advisor perspective. Now, before we hear from our key presenter, I've just got one or two housekeeping notes for you to ensure that you're able to get the best from today's session. Firstly, would you please be kind enough, unless you're a speaker, to turn off your camera and microphone. This is a limited bandwidth platform and the session will run much smoother if only the speakers are on camera. I hope that you don't mind that. There will be a question and answer session following Rob's presentation, and you're very much encouraged to participate. We'll be taking the questions through the chat icon, which you should find at the bottom of your screen. And Tom, if Philip can't get in, will be chairing that Q&A. If you could please resist the temptation to ask questions by speaking through the microphone, we'd greatly appreciate that. And Philip or Tom will endeavour to ensure that all of your questions are put to Rob after his presentation. And now, as Rob sets up his presentation, let me tell you that, as promised, this session will qualify for 1 hour of CPD, and my colleague Joe will be emailing you your certificate after the event. I guess I should also add that your attendance at this event does qualify you for an entry into our December prize draw to win a £2,500 Kuoni holiday voucher. Now, I realise that might sound a bit weird at this time when we're all locked down, but please don't worry, it will be valid way into 2022. So I hope that Rob might be close up and ready. He is. So without further ado, let me hand over to Rob Peroni from Orbis Investments. Rob.
Yeah, thanks very much, Andrew, and thank you everybody for coming. Let me just start by saying, you know, I wish we were doing this in person, and I'm sure the time will come again when we can do it in person. But just to acknowledge, look, it's been an incredibly difficult time for a lot of people. We've had to take steps as a firm to protect our staff and our communities, and just we hope that you and your families are safe and are healthy. At a time when people have so many other serious things to worry about, it can feel a little bit strange to be talking about markets, but it's what we do for a living. So we'll speak about that today. The way I want to structure my talk today is I just want to start by setting the stage and covering off a little bit of the market volatility that we've all seen over the past couple of months. And then I want to dig into a challenge that we're facing as investment managers, and I think probably a lot of you are facing as advisors, or your clients are facing, which is in an environment where things look so risky and where broad asset valuations don't look particularly appealing, how can you generate returns in a low risk way? Are there options that can fulfill that role in a portfolio? So we'll take a look at those in just a minute. But first, let's dive into the volatility. So the recent environment, we've seen really unprecedented volatility in stock markets. We've seen the worst 4 weeks for global stock markets really ever. However, we've also seen one of the best 4-week periods for stock markets ever, the bounce from the March 23rd lows. Really incredible volatility in the equity markets. That's not for nothing. It's been driven by, of course, the lockdowns and the incredible economic hardship that those are causing. So if we look just in the US, more people losing their jobs in a single week than in the entire year of 2008 when Lehman Brothers crashed. The numbers from the ONS in the UK, I think just a couple of days ago, similarly dire picture, really terrible economic hardship in the real economy. But against that, there's this huge countervailing force, which is the central banks. You know, they've stepped in with an incredible response in terms of the scale of their asset purchases and the money printing. The Federal Reserve in 2 months has printed more money, bought more assets than it did during the entire global financial crisis. And so markets are torn between, on one hand, the real economic pain in the real economy, and on the other hand, this incredible intervention by central banks. It's created a really challenging environment in which to generate attractive low risk returns. And when we kind of size up these options, what I want to do is I want to start by digging us into a hole. And then from that hole, I want to see if we can claw our way out and find options that are more attractive for a low risk portfolio today. Now, here's the hole. For the last 30 years, government bonds have been a really terrific part of a multi-asset portfolio. They've balanced against equities, they've generated returns, and they've done that in a really steady manner. The problem is today, $12 trillion worth of bonds around the world trade at negative yields. And so we think it's incredibly unlikely that they can continue to perform that low risk return role that they have in the past. Now, as of yesterday, 3-year UK gilts are part of this club, right? You have yields negative in some parts of the gilt curve as well. Now, longer term bond yields in the UK are still positive. 10-year gilt at the end of April yielded 0.2% to maturity. Not much to get excited about, but at least it's not a guaranteed loss, except, however, that's on a nominal basis. So after you consider expected inflation, you're actually looking at a negative 2.6% real yield. Now, again, you're not baking in a loss, a nominal loss that you'd see on your pricing statement, but you are baking in a loss of purchasing power. And that's ultimately what matters for people who are trying to save for their retirement. And the other risk that we worry about with bonds is not just that their return potential looks bad, it's also that we think they carry substantial risk today. And when you consider a government bond, it's customary to say, okay, there's not any credit risk there. However, there is still interest rate risk. And this is the sensitivity of a bond's price to changes in market interest rates. And for the last 30 years, this has been going all one way. So market yields have fallen, bond prices have risen. And if you consider just a simple example, let's say you have a bond with a 3% yield, and then the prevailing rate in the market drops to 2%. Well, now everybody in the world will be willing to pay more than full price for your bond because your bond pays an above market rate of interest. That's been the way things have gone. That's been a lovely tailwind for investors in bonds. The thing that scares us today is that the same thing is true in reverse. So if you own that 3% yielding bond and the market rate goes up to 4%, well, now nobody is going to want to pay full price for your bond because your bond pays a below market rate of interest. And the impact of that yield change on the price of your bond will depend on how long-term your bond is. If you have a very long-term bond, you can imagine someone saying, okay, that bond pays a below market rate, and geez, I'm going to be stuck with that below market rate for a really long time. So I'm going to demand a very big discount to take that off of your hands. Whereas if you have a shorter term bond and yields rise, perhaps someone looks at that and says, it's still below market rate of interest, but I'm only stuck with that below market rate for a year or two, so I'm not going to require quite as big a discount. So this interest rate risk, we think, is something that investors really need to be mindful of when considering bonds and also some other assets. And if we try to calibrate how worried about this should we be, I think it's instructive to look at the path of bond yields recently. So in this latest crash, the thing that sticks out to me from this chart is that bond yields fell where they had room to fall. So bond yields fell in the US, they fell in the UK, but if you look at places where yields were already negative, if you look at Germany or Japan or Switzerland, yields there didn't actually set new lows. And what that suggests to us is that there might actually be a lower bound of interest rates. Perhaps we found it. Not zero, but there may be a level beyond which bonds really struggle to go more negative. And that would suggest to us that the risk to bond yields from current levels is probably less to the downside, less worried about them going even more negative, and more to the upside. So bond yields returning to more normal levels. And if we just drill into the UK, we can consider the 10-year yield as an example. So today, as I said, at the end of April, 10-year gilts yield 0.2% to maturity. So if nothing changes, if yields stay exactly as they are, that's your return for 10 years. Really not anything to get excited about. Now, over the long term, you've been able to get perhaps a mid-single digit return out of gilts. What would you need to believe to think that you're going to get that sort of return today? Well, to think you're going to get 7% out of gilts, their yields would have to go to negative 0.5%. Now, that's not impossible. That's not crazy. 10 years ago, we might have said negative yields look crazy, but stranger things have happened. The thing to be aware of is that if you're invested in gilts and you're expecting a 7% return, you are counting on this happening. This is the only way that you're going to get a return that high out of a long-term government bond. Now let's consider the other side. Let's consider the risk. What if gilt yields go to just 1%? Again, you wouldn't even have to go back 1 year to see them trading at this level. Well, in that case, you would lose 6% on these bonds. If they went to 1.5%, again, you don't need to go very far back in history to see them trading at this level, you would lose 10%. If they went to 2% gilt yields, you would lose 14% on these bonds. So 0.2% yield facing potentially double-digit downside, we simply don't think long-term government bonds offer an attractive balance of risk and return. And that presents a real conundrum for multi-asset investors, because if you become accustomed to bonds providing that low risk return in your portfolio, but you need higher returns and bonds aren't going to do it anymore, one of the options many investors plump for is simply take more risk. Start considering riskier options in the hopes of extracting that same level of yield or return. And so us taking more risk in pursuit of yield or pursuit of return is a little bit like walking the plank. So this pirate captain with the beard, you can imagine that's central bankers, maybe that's Jerome Powell, that's Andrew Bailey. And staying on that pirate ship is going to be bad for your health, right? That pirate captain might stab you if you don't walk the plank. That doesn't mean, however, that jumping off the plank into shark-infested waters is going to be good for your health. That's risky as well. And so we think as investors walk out this risk plank in pursuit of the yield that they were accustomed to, you need to be incredibly mindful of the risks that you're taking in pursuit of those returns. So for a lot of investors, if government bonds can't perform that low risk return role, the next step is they're going to start to think about corporate bonds. So let's take a look at those. Now at Orbis, we're fundamental investors. And what that means is when we look at an equity, we think about it as a business owner. When we look at a bond, we think about it as a business lender. And the key thing that you would be concerned with as a business lender is what is the creditworthiness of the companies that you are lending to? And one way to capture that is the bond rating. Now, just for starters, let's look at the overall level of debt in the corporate world. In the investment grade space, it's just about doubled from about $5 trillion worth of debt during the financial crisis to over $10 trillion worth of debt today. Already not a good starting point. You don't want to lend to someone who has more debt. But the thing that really scares me about this slide is this. Almost all of that growth has come from the lowest rung of investment grade bonds. Almost all of the growth has come from that almost junk BBB rated bonds. So not quite junk, but only one notch away from junk. And that part of the corporate bond market has grown from a quarter to a half. Now, what that means is if you buy a basket of corporate bonds today, the credit quality of those bonds is significantly lower than it was in the past. But of course, against fundamentals, you always have to consider what's the price you're paying. So what sort of compensation do you get for credit risk today? And here I've just plotted global corporate bond spreads. So this is the difference in yield between a corporate bond and a government bond. Corporate bond has a bit more risk, so you should expect to get a little bit of compensation for that credit risk that you're taking. And you can see coming into this year, bond spreads were incredibly narrow. You're getting very little compensation, really almost none, for lending to a company rather than to a government. And then the lockdowns hit, and bond investors reacted and said, geez, a lot of companies don't have revenue coming in. They might be facing financial stress. I'm going to require a much higher yield to lend to those companies. But the fascinating thing to me is you see the spike. You see yields went up, and they came down almost as sharply as they went up. What happened there was the Federal Reserve came out and said they're going to start buying corporate bonds. So in essence, they've suppressed the yield on these bonds. And that makes them much less interesting to us, because what it means is you have a situation where the economic consequences are still there. Businesses are still shut down. They're still not bringing in profits and cash flows. And so their creditworthiness is still challenged. However, because of central bank intervention, the compensation in the bond market just isn't there. So we don't think corporate bonds can perform the low risk rule either. So for a lot of people, government bonds don't work. corporate bonds don't work, the next step out as we walk the plank is going to be real estate. Now, you can look at listed real estate, you can look at REITs. Now is a pretty tough time to be a landlord, however. If you're a commercial landlord, shops are closed. Companies don't have people working from offices. Businesses that are struggling to pay back their bondholders are going to struggle to pay their rent as well. And if you're a residential landlord, you've seen numbers out of the US, lots of people are not paying their rent. Very challenging time to be invested in listed real estate. Now, of course, you can say, okay, well, maybe instead of that, I'll take exposure to unlisted property. The challenge there is that if you're invested in an illiquid asset, but your clients need liquidity, you can end up in a situation like this. We've all seen the headlines over the past couple of years, property funds having to close because they weren't able to meet client redemptions with the illiquid assets in their portfolio. And so we think real estate has some really substantial risks as well. It's not going to be a good alternative either to generate low risk returns. Now, at this point, things aren't looking great. We continue to walk this plank. We're not finding anything that looks low risk. Maybe at this point, we have to start stepping into the stock market. But keep in mind, we're trying to manage risk here, so we're only going to sin a little bit. We're only going to buy the defensive, consumer staples, stable type businesses. Okay, well, what could be wrong with that? Now, let's remember, part of the reason that we're walking this plank is that bonds have that interest rate risk associated with them. If interest rates go up, bond prices are going to fall. Now, if we go to defensive equities in the hopes that we're going to escape that risk, this chart tells us that's not going to work. So what I've done here is in light blue, I have the performance of defensive stocks compared to the world stock market. And in dark blue, I have global bond yields. And I've flipped the yields so that you can see the relationship. The thing that sticks out is it's almost a one-for-one line. So these defensive stable companies do really well versus other stocks when bond yields are falling. But of course, the same thing's true in the other direction. Should bond yields rise, these stable equities you would expect to sharply underperform other stocks. And so a lot of investors look at these kind of equities and they say, these have all the safety, all the defensiveness of bonds, and all the upside and return potential of stocks. We look at them rather differently. We think actually they have a lot of the same risks that bonds have today, and they also have equity risk associated with them. Defensive equities are still equities. If we just look at how they performed in the coronavirus-related sell-off, in dollar terms, global stocks fell 34%. Procter & Gamble and Unilever fell less to 21%, 25%. I think if most of us spoke to our clients and said, hey, we've had a really low risk experience, we're only down 25%, they wouldn't exactly be giving us a pat on the back. And if you look at soy sauce company Kikkoman in Japan or Coca-Cola in the US, Diageo in the UK, they fell just as much as the wider stock market. So these defensive equities are not a panacea. Their fundamentals can be stable. They do still have stock market risk and can hurt you on the downside. So we return to our plank. Things are looking truly desperate. Government bonds aren't going to work. Corporate bonds have risks too, so does real estate. And these defensive stocks aren't going to protect us either. What can we do? Well, it's at this point that a lot of investors, rather than timidly walking down the plank, say, screw it, I'm going to use the plank as a diving board and jump directly into those shark-infested waters. I'm just going to go into equities because there is no alternative to equities, Tina. There is no alternative in particular to US equities. Now, the reasoning here is not incredibly sophisticated or subtle. It's simply US stocks have performed incredibly well over the last 10 years, such that if you've been invested in really anything else, you felt sort of foolish about it. Now, I'm not going to belabor the point here. I think we all understand simply investing in the S&P 500 is not a low-risk proposition. Year to date, it suffered a peak-to-trough drop of 34%. So what can we do? We've looked at all these traditional low-risk options. None of them appear to offer attractive risk-adjusted return potential. Some investors are getting desperate and just setting aside risk entirely and going into stocks. Rather than succumbing to Tina, I'd like to introduce you to my dear friend, Tasha. And Tasha stands for There Are Some Healthy Alternatives. And as we look at markets today, we think rather than jumping into the shark-infested waters, maybe think about a lifeboat. The assets that we would have in our lifeboat would be short-term bonds, so essentially cash, gold, and hedged equity. Now, if we look at short-term bonds first, of those three, I think a lot of investors would say, oh, I've allocated to bonds, and bonds are low risk, so job done. I've managed risk. But not all bonds have the same levels of risk. Not all government bonds have the same levels of risk. Not even all government bonds from the same country have the same level of risk. And you can see that here. 10-year gilts, weekly returns shown in yellow, have been significantly more volatile than 2-year gilts, with weekly returns shown in dark blue. And the reason here is that interest rate risk that I talked about at the opening. The 10-year bond, if you're stuck with a below market rate, you're going to be stuck for a much longer period of time, so the price is going to be much more sensitive. Long-term bonds have much more interest rate risk than short-term bonds. That feeds through, as we see here, to greater volatility. It also feeds through to their drawdown experience. So over the last 40 years, 10-year gilts have suffered price declines as great as 14%. 2-year gilts have been much more stable, much smaller price declines. Same story if we look at what's happened in March 2020. There was actually a period where 10-year gilts were down as much as 6%. 2-year gilts were essentially unaffected. So in an environment where broad asset class valuations don't strike us as particularly compelling, we think rather than being in the long-term bonds, we want to go to something that is truly low risk. Short-term bonds fit the bill. Let's consider another alternative, gold. Now we can look at gold from a couple of different angles, and we can get into that in the Q&A if you like. The angle I've got here is just the portfolio manager's perspective. Gold is a wonderful diversifier in the portfolio. So if we go back to 1970 and we look at every week and we say, how did stocks do? How did gold do? This is the correlation we get. Over all weeks, gold is relatively uncorrelated with stocks, and that's already a good starting point because that suggests to us that you're getting a real diversification benefit out of holding gold. But where gold really shines is in the crash periods. So in weeks where equities fell more than 6%, gold was actually strongly negatively correlated with equities. And what that means is, while as your stocks were going down, the gold price was going up. It was providing a bit of balance to the portfolio. The third option, low risk option in our lifeboat, is hedged equity. Now, I might just pause here and say, I think a lot of managers think about hedged equity as something on the periphery of what they do. They might shove it in a basket with kind of alternatives, and it's kind of a black box. That's not how we use hedge equity. For us, it's really a core tool, and it's one that the way we do it, it's incredibly transparent. So all we're doing with hedged equity is any stock in the world, you can think about its returns into two parts. You split up those two parts. There's the market return and the difference from the market return. So all we're doing with hedged equity is we're going out into the market, we're buying the equities we like, and then we're using stock market hedging to strip out the market component of returns, leaving just the difference between the return of the stock and the return of the market. Now, when you strip out the market return, two things happen. One is you also strip out the market volatility. And so hedged equity is much less volatile than a long equity exposure. The other thing it does that we really like as a tool is it means that your returns are not driven by the overall direction of stock markets. With hedged equity, if you pick good stocks, you can make money even if market returns are negative. Of course, you can also lose money even if market returns are positive if your equities underperform. So those are kind of the three low risk options that we like. The key thing to think about with hedging, however, is that it only works if you combine it with active stock picking. If you go long the S&P 500 and then hedge the S&P 500, that's just a convoluted way of getting a cash return. It needs to be combined with active stock picking. And that really feeds through to how we view multi-asset investing in general. You know, I think a lot of people are very comfortable in an equity fund being bottom up. Of course you're bottom up. You go around the world, you see the stocks you like, you buy those stocks, and those individual stocks are the building blocks for the portfolio. But as soon as you start speaking about multi-asset investing, I think a lot of investors begin to think in buckets. And it's not about the individual securities anymore. It's about how much should I allocate to stocks? How much should I allocate to bonds? From our view, that doesn't make a whole lot of sense. Rather than ask how much should we have in stocks, how much should we have in bonds, we think we have much more of an advantage if we say which stocks actually look attractive and which individual bonds actually look attractive. And then we build the portfolio using those individual securities as our building blocks. Now, active stock picking only works if you're able to find opportunities that offer better returns in the market. To touch very briefly on just one sort of opportunity we're finding today, it's in broadly value shares. Now, we are valuation-oriented managers, but we're not classic value managers. We don't just go out and buy whatever trades at the lowest price-to-book multiple. We think growth is an incredibly important part of a company's intrinsic value. But in the current environment, we do think those cheaper shares in the market look particularly attractive. And this is really my favorite chart to illustrate this. So what we've got here, if you look at the dark blue line, that's the performance of growth shares versus value shares. And you can see, really since the global financial crisis, growth shares have been just dominating value shares. I mean, in recent months, it's gone almost vertical, the degree of the outperformance. Now, that's one thing you can make as an observation and say, growth is beating value. But for us, it's never about what goes up must come down or what goes down must go up. It's always about the relationship between prices and fundamentals. And what we see here, and this is the light blue line, is since the global financial crisis from about 2008 to about 2016, look, sure, growth was beating value, but it was justified because growth companies were growing their earnings that much more quickly than value shares. So it was driven by fundamentals. The thing that gets us excited today is that since 2016, those two lines have diverged. Growth shares have outperformed to a ridiculous extent, but it hasn't been driven by better fundamental growth, better earnings growth. In fact, earnings growth for the two buckets of shares are actually been pretty similar. So this gap makes us think that the recent outperformance of growth is not justified by earnings, makes us think the opportunities available in value shares today might look really unusually attractive. So we're pretty excited about that. And this is kind of our perspective generally as stock pickers. If you'll permit me just a couple of minutes at the end here to speak about who we are. Orbis has been around for 30 years. We're active global investors. We describe our investment philosophy as fundamental, long-term, and contrarian. So in essence, we're trying to buy businesses at a discount to what they're really worth. We've got 10 offices around the world, and our clients have entrusted us with over 20 billion pounds of assets. Now, you may not have heard of us before, which may be surprising given the asset figure and our longevity. The majority of our business historically has been in the institutional market, and it was only in 2013 that we made our products and services available to the advised channel in the UK. And so in the UK, our fund family looks like this: Cautious, Balance, and Equity. Cautious is the baby of the family, and that it's both the youngest with an inception in 2019, and also the lowest risk member with a risk rating of 4 from De facto and Dynamic Planner. And as I was talking about that lifeboat, really Cautious is what I have in mind here. And just to illustrate how different we are from the market, on the left you can see the benchmark for the fund. That's 30% global stock markets, 70% global government bonds. And that's been a mix that's worked pretty well historically. And in fairness, it's also worked pretty well since 2019. On the right, you can see that, look, we haven't actually taken a lot more equity risk in this environment. That would be one way to generate a higher return, but we don't think it's appropriate because it means you're taking more risk. Instead, we've got those three things I talked about as being our lifeboat. So in place of government bonds, which we think offer low returns and lots of interest rate risk, we have hedged equities, that active stock picking combined with market hedging. We have short-term bonds, the short-term gilts I talked about, selected corporate bonds, and then we have gold. And within the equities, our positions are pretty concentrated, very active, and again, very distinct from the market. So a mix of companies from pharmaceutical to British American Tobacco, Taiwan Semiconductor, a gold miner, and integrated oil major, BP. Very active investors, very concentrated, different portfolios. Now, since its inception, the performance of Cautious has been frankly really disappointing. This is these sorts of returns are well below the standards that we set for ourselves versus our benchmark. But as I mentioned, the key thing for us is always what's the relationship between price and value. As we look at what's driven this underperformance, coming into this year, we had a basket of opportunities that we thought offered really unusually good value versus the benchmark, and in absolute terms, they have only gotten more extreme during this sell-off. So we thought bonds were unattractive before. We think they're even less attractive now. We thought growth shares were beginning to look a bit punchy before. We think they look even more stretched now, to the point where I was speaking to our portfolio manager last week, and I asked him, Alec, what do you think on a scale of 1 to 10 is the relative return potential from here? And without hesitating, he said 10. I've never heard him be that enthusiastic about the relative value in the portfolio. But we recognize that that kind of performance experience is really challenging for clients. And even if we do a good job applying our philosophy over the long term, it doesn't count for anything, really, if clients aren't there to stick with it along with us. And so what we've done is about 10, 15 years ago on the institutional side, we tried to come up with a way that would make it easier for clients to stick with us through those inevitable tough periods. And what we came up with is our zero base fee structure. So with this structure, our base fee is zero. If we don't outperform, we don't get paid. Now, if we do outperform, the fee is 50% of the outperformance versus the benchmark, but it doesn't come to us directly. Instead, it goes into a reserve. And if we subsequently underperform, we actually refund fees. We pay fees back to clients at the same rate. And if we find ourselves in a position like we're in now, where we've underperformed, we refunded fees, and we continue to underperform, what we say is, look, we feel it's only fair. We need to make clients whole again. And so today, in the Orbis OIC funds, we need to outperform our benchmarks by over 10% before clients will pay even one additional pound in fees. We think it's a really interesting time to be considering an investment in our particular lifeboat. And that's all I've got. Thanks very much for your time. Look forward to the Q&A.
Okay, Rob, thank you very much indeed. And before I hand over to Philip, who I'm delighted to say has now been able to join us, just a quick reminder that you can ask your questions, and we really hope that you do, using the chat function. And you'll find that, as I've said earlier on, that you'll find that at the bottom of your screen. So just to reiterate, Philip Martin's a great friend of professional advisors. He's currently the managing director of the advice firm Unique Financial Planning. Philip, I know you've got one or two questions of your own, so welcome, and let me hand over to you now.
Thank you, Andrew, and good afternoon, everyone. And thanks to you too, Rob, for your presentation. One thing that I picked up on that I thought was interesting to explore a bit further was this idea of hedged equity as an asset class. So I took that to mean that you were making stock selections in anticipation that you would then be able to capture the excess of that stock's performance over the general market, or alternatively capture less of the downside if the market was falling. So can I just check, is that correct? That's what it's aiming to achieve.
That's exactly
and I guess
right.
Secondly, over what sort of time horizon are you making those judgments?
Yes, so we would always say that when we're evaluating an individual company after investment, we want to take a long-term horizon. So we're looking with a 3 to 5 year view of the fundamentals. Now, that doesn't mean that we start a stopwatch when we invest and we're counting down. So, on year 1, we're thinking about year 5. On year 2, we're thinking about year 6, and so on. And so there have actually been holdings in some of our portfolios that we've held for decades. On the other hand, sometimes you buy a stock, you think it trades at a discount, and it goes up a lot really quickly. Well, in that case, we might not need to hold it for quite so long. We might sell over a shorter period. There are also cases where we just get it wrong, and information comes in that leads us to believe that our thesis is broken. In those cases, we also would be willing to sell before that 3 to 5 year horizon. But that's always kind of the time frame that we have in mind when looking at an individual company.
Okay, and again, just trying to pick up on a few of the points that you've raised through your presentation. You talked about growth versus value and the relative performance over various different periods. As a house, are you set up to particularly favour one over the other? And if the answer to that is no, then how are you opportunistically switching between the two to drive performance?
Yeah, so I think the answer is no. So, our focus on fundamentals does make us very valuation oriented. We're always asking, what's in the price? What sort of price do you have to pay for an asset? But we think just being a textbook value investor can actually get you in trouble. If you're just buying whatever's cheapest on price to book, well, then I really hope you like banks, because you're going to own a lot of banks just about all the time. And just as we would say, we think it's crazy for an investor to ignore valuation, we think it's crazy for a valuation investor to ignore growth. Growth is one of the most important fundamentals you can have in a portfolio. So we look at a company like Alphabet or like Taiwan Semiconductor. These businesses trade at a premium to the wider market. We think that premium is more than justified by their superior fundamentals. They generate such high returns on capital. Their growth prospects are so much superior to that of the wider market that we're very happy to buy those, quote, growth type shares in the belief that they trade at a discount to their long-term intrinsic value.
Yeah. Okay, well, I've had one question through. It's come directly to me, actually. So, and it's really a follow-on from that discussion. So, what specific positions, this question asks, has the Global Cautious Fund taken during the crisis to try and make the most of the potential of the upside and recovery? And I guess that perhaps ties into your hedged equity point as well. So, might neatly bring them all together.
Yeah, I think it does. So, so one thing that was interesting during the crash is most of our hedging is done in a very straightforward way. We do, from time to time, use options as a kind of crash insurance, and those held up remarkably well during the crash. They did their job, provided a bit of a cushion, which then provided the cash that we could then take and invest in other opportunities. So in our multi-asset strategies, we've added to some of the things that were hit the most, as you'd expect. We thought they were cheap before. After really rigorous stress tests, analysts putting in, assumptions like BMW doesn't sell a car for the next year, and what does its balance sheet look like? Oil prices don't move up a single dollar a barrel. What do BP and Shell look like? After engaging in that kind of stress test, we've concluded that some of the more cyclical shares in the portfolio really traded at a discount before, traded at an even more extreme discount, and so we've added to those a little bit. But as I said, look, as a house, we don't just buy whatever's down the most or sell whatever's held up the best. So there are some situations where there are companies that we knew well, that one of our 40-odd analysts around the world had analyzed and researched in previous years, that had never really traded at attractive enough levels for us to pull the trigger on an investment in the fund. When those shares sold off, we viewed that as an opportunity to pick up some really wonderful businesses at prices that you don't normally get to buy them at. So two examples would be, Alibaba Group was recommended by two analysts in different teams in the firm. When it sold off, and this is a company that's grown revenues by 50% per annum since its IPO, when it sold off to 20 times earnings, we thought that was a remarkable bargain. We took advantage of that. Another one would be Comcast, so one of the largest broadband providers in the US. Again, not usually a business that you get to buy for a very cheap price. It sold off because a small portion of its earnings come from a theme park business. We thought that was a great opportunity as well, and so stepped in, took advantage of that opportunity to buy a great business at an unusually good price. So it's been a real mix, but I think the upshot would be, we think the fundamental quality of the stocks in the portfolio is higher than it was at the beginning of the year. And perhaps more importantly, we think the portfolio is much, much cheaper compared to intrinsic value than it was at the beginning of the year.
Great. Well, I've actually had a question through. We'll maybe take this stock question before we move on to some of the other asset classes that you touched on. So Neil Donaldson's asked, picking up on your slide for the cautious fund, do you really consider that BP is a cautious stock in the current environment?
Yeah, well, I think whenever we look at a security, we would look at risk in two dimensions. So one is at the individual security level, right? So do you think you're going to make or lose money in the stock? As valuation-oriented investors, the key risk that we are concerned with is the risk of a permanent capital loss. And we think the best way to avoid that risk is to avoid overpaying for assets. That's the key consideration at the individual stock level. BP is in essence so cheap that we think that risk is pretty limited. If you think about, okay, well, BP has some oil exposure, that's true, it does, but it's also an integrated business. And so if you compare BP to an upstream company that generates all of its revenues from selling oil and gas, well, BP has refining, BP has marketing, it has service stations around the world, it has a trading business that can profit from volatility and the oil price. It also has a much lower cash break even than many other companies in the oil patch. So if you compare BP or Shell to shale in the US, so shale oil producers, a lot of those companies can't even cover their cash production costs at the current oil price. BP and Shell can actually generate modest positive free cash flow. What that tells us is that in an environment where there's pain in the industry, the weaker players are going to be the ones who bear that pain, and their reaction will help to rebalance supply and demand. The stronger companies with better balance sheets, like BP, like Shell, will be the survivors that end up sticking around to reap the rewards. Now, that's kind of all at the company level. At the portfolio level, we think it's difficult to make a judgment on any individual security without considering the context of how it fits in with the other things that we hold. And so, look, BP has some exposure to energy that can introduce volatility. Whether it's appropriate in a cautious fund depends entirely on the position size and on what else you own. So we think as part of a diversified portfolio, where we have about 30% of the fund in short-term bonds, where much of our equity exposure is hedged, we think the modest position we have in BP is entirely appropriate.
Okay, thank you. Well, let's say, I mentioned just before that question that I'd had that through in the group chat. It's gone a little silent through it. Please feel free to. But let's move on to pick up on one of the other asset classes that you touched on, which was gold. I was interested to know how you're using gold in a portfolio. Is it purely a defensive play because you see volatility appearing in the wider market, or would it always form a core part of a portfolio for you?
Yeah, so if we look at the balanced fund, which has a longer history than cautious, there have been periods where we didn't hold gold, but for the last several years we have. We look at it really from three angles. So one is the simple diversification perspective that I included in the presentation. Another is, well, let's think about what's bad about gold. And what's bad about gold is it doesn't produce cash flows. It doesn't produce a yield. If other assets aren't producing a yield either, so bond yields are low, well, then the opportunity cost of having gold is maybe not so tough to bear. And so the price of gold tends to go up. Another way of saying that is gold price is highly correlated to real yields, inflation-adjusted yields. What that tells us is an environment where government bonds do well is one where gold should probably also do pretty well. And so we think it can fulfill that low risk role in the portfolio. The key difference is that gold can hold its value against inflation, whereas inflation is the thing that will destroy the returns of a nominal bond. The third perspective we think about with gold is, look, you can talk about it in the abstract as this kind of investment asset, but ultimately it's a commodity out in the world whose price is determined by supply and demand. And so what do supply and demand look like? And on the demand side, if you look at the emerging world, if you look at India or China, a lot of people in those markets, the moment that they achieve an income level where they can begin to think about investing, one of the first things they want to reach to is gold. We think the emerging middle class in those countries is likely to provide a nice, steady, modest tailwind to demand for gold. If we then switch and look at the supply side, one thing that distinguishes gold from other commodities is we've been mining it for thousands of years. And so when you've been mining something for thousands of years, you tend to find the best stuff first. And so new gold discoveries peaked over a decade ago. Mine supply, I believe, has also peaked. What that means is that it's becoming increasingly difficult for gold miners to go out and explore and find new developments that they can extract at attractive prices. And so over the long term, we would expect mine supply to probably fall for gold. So if you have steady growth in demand, steady decline in supply, we think that's a constructive environment for the price of any commodity, including gold. So whether we look at it from a diversification perspective, by comparing it to bond yields, or simply looking at supply and demand, we think gold looks pretty attractive today.
Okay, and I guess the third asset class that you touched on in a great deal of depth actually was bonds and the relative attractiveness, and in particular the issues around duration and the sensitivity of the price to movements in the interest rates. How does your view of duration affect?
Oh, sorry, I've lost you, Philip. Andrew, can you see Philip? Or we lost him?
Philip, I've lost him. I might be able to help with that question. Just give me 2 seconds, and I'll see what I can do.
I have lots of things to say about that.
Yeah, I think his question was basically around bond risk and duration, and how you see that.
Sure. So Andrew, if you wouldn't mind muting, because I think I'm echoing a little bit. We think duration is a clear risk in bonds, right? And that's almost just a mechanical thing with bond math. As yields rise, prices fall. The other thing, as I pointed out, is that it's affecting other asset classes too. So those defensive equities I highlighted, they're correlated with bond yields. The reason for that is people faced with declining yields are going for the most bond-like things they can find in the equity market. Another way of saying that is people are going for long duration equities. And one way of thinking about duration is as a measure of interest rate risk. The other way of thinking about it is just, well, when do you get your cash flows? And so in an environment where inflation has been low or non-existent, interest rates are zero, if I'm Tesla and I rock up and I say, I'm not making any money now, but don't worry, I'm going to make a tremendous amount of money in 20 years, how patient are you? How willing are you to wait? Well, if interest rates are zero, you might be really patient, right? Because you're really not giving much up to wait for those profits. If interest rates were 5% or inflation were higher than it is, you might be a bit less patient. You might say, well, hold on, if I can collect a decent yield on a bond year after year after year, maybe I want to do that rather than waiting for these returns in the distant future. If inflation is eroding the value of those distant profits, maybe I want to be a little bit less patient. We think that sort of dynamic has been completely one way for a very long time. The chart I showed with kind of bond yields bottoming out for those that are already negative suggests to us that even if that dynamic doesn't reverse, if it simply just stops, then there are a whole lot of assets around the world, including high growth or highly stable equities, whose valuations will stop getting more expensive. And if their valuations stop getting more expensive, we think it's very hard to get a good return out of those businesses, because as I showed, their outperformance in recent years has not been driven by fundamental growth. It's been driven by rising valuations. So it's a risk that we're concerned about, not just in bonds, but also in equities.
Okay, Rob, thank you. It seems we've lost Philip for a wee while, but fortunately we've got Tom Ellis, our editor, on the line, and I know that he had a couple of questions he wanted to put to you also. Tom.
Hello, Rob. Hello, everyone. Sorry for the mad hair. I wasn't expecting to be on camera today. Quick question from me, Rob. In terms of the fee structure Orbis has for its funds, how does that work for clients coming in and out of the fund between standard valuation periods, if it's not like a year or something like that? How does that exactly work?
So how's the fee assessed, do you mean?
Yeah.
So we actually run it daily. So the So the key thing, right, is the flows between the client and the reserve, which can go either way. That happens daily and is assessed daily, and so it's reflected in the net asset value of the fund whenever clients transact. So it happens essentially immediately.
Okay. I think I've got a last question from me. If anyone else wants to ask a question before we finish up, just throw it into the general chat and we can get that across to Rob. I'm not sure if Philip has asked this already, but do you have a consistent house view towards either, growth versus value? So I think you guys are mostly value focused, but how does that feed into equity valuations at the moment, especially?
Yeah, so Philip and I did discuss it a bit. We are not we're valuation oriented, but we think growth is a pretty important component of a company's intrinsic value. And so we're willing to be opportunistic and go from one to another. If you look at the track record of our global strategy since 1990, you can actually see that. Now, we've tended to do better in environments where value does well, but unlike a traditional value fund, it's not symmetric. So we do well in value and we keep pace during growth markets rather than doing well in value and bad in growth. The thing that tends to hurt us, the environments we find really challenging, are when trending persists for a long time. So when there's a heck of a lot of momentum, particularly when that momentum is concentrated in a small number of shares, it puts us in a situation where, like bond yields have been, I'm saying they're unattractive now. We thought they were unattractive a year ago, 2 years ago, 3 years ago. When you get momentum like that, it puts us in a challenging situation of, okay, we thought that was expensive before. We thought something else. The expensive thing has continued to outperform. The cheap thing has continued to underperform. That's painful while it happens, but it doesn't for 1 second make us think we should then sell the cheap thing so that we can buy the expensive thing that's gotten even more expensive. So we're willing to be flexible, but we always have an eye on both valuation and on fundamentals.
Cool. I think we have Philip back here.
Yeah,
and we have audio.
Back. I'm not sure where we've got to. Apologies. This technology seems to be defeating me at the moment, but I'm back in. Have we got time for one more question? I'm not sure if anything else has come through in the group chat.
Yeah, there's one in the chat.
It's not letting me see it for some reason, Tom. Would you want to just pose that question?
Yeah, sure. Nicola asks, what's your approach to asset allocation in your multi-asset funds? I think we saw that you're not a big fan of government bonds in your table, but I guess you could expand on that a bit.
Yeah, look, I think the way we often describe it is we're not trying to do anything weird, right? The objective of the fund is very standard, kind of moderate risk. Where we're a bit different is we are agnostic about how we get there. So I think a lot of people would say moderate risk equals 60-40, and that's how you do it, and that's it. But a static asset allocation doesn't deliver a consistent level of risk because the risk and return of different asset classes is changing all the time. And so we want to be responsive to that. So when we were setting up the fund, we gave ourselves a lot of flexibility with the asset allocation parameters. If you looked at how we've used that, it's not been because we wanted to tactically dive in and out of different asset classes. It's really because we want those parameters to get out of the way and let our bottom-up security selection drive the positioning of the funds. Now, when we do that, we're always focused on risk, right? So we want to deliver the risk mandate that's consistent with the fund's objective, but we want the positioning to be driven by which individual securities we find attractive, not by asset class constraints, because we think some of the assumptions underpinning that view of risk may not be persistent.
Cool. Thanks, Rob. I think I'll pass back to Andrew.
Okay, ladies and gentlemen, that seems to be we've reached the end of questions. Are there any more? No. Okay. Well, let's just looks as though we can wrap it up then for our first virtual working lunch. I hope you've enjoyed it and found some real value in the session. I know there's been a couple of technical issues, so it just shows the strength of having a decent bench, so you can pull off someone off the bench to fill in. For those of you who've had those technical issues, thank you for bearing with us. Now, if you've got any questions that you'd prefer to ask offline or would like to learn more about Orbis Investments, I'm quite sure that their business development managers would be more than delighted to hear from you. For those in the Southwest, that would be Chris Johnson. In the home counties in East Anglia, Lynn Lee. And in the Northwest and Midlands, Ben Collinson. And you'll find all of their contact details on the joining instructions that Joe sent to you just before the meeting. So all that remains for me is to thank our two speakers, Rob Perrone from Orbis Investments and Philip Martin from Unique Financial Planning, as well as Tom Ellis, our intrepid editor, our sponsors, Orbis Investments, for making this session possible, and ever aware of the extraordinary demands on advisors' time at the moment, let me reserve our most heartfelt thanks to you, our delegates, for your company this lunchtime. I hope you found it useful and informative. We will be emailing your CPD certificates to you later this afternoon. So until we meet again, thank you very much for your company and goodbye.